All right. Well, let me also on this juncture of the show bring on board Amit Jeswani, who's in fact joining us right here in the newsroom. Hi, Amit. Pleasure having you with us on Markets at Lunch. We were having all that oil chatter, but at the end of the day, you take a look at India's macros as they stand currently. And we were chatting earlier, and you had a very interesting terminology that you gave it. All of these weekend and Friday evening announcements that we are getting from Nirmala Sitharaman, and you called it the Nirmala put. So if you could explain that to our viewers first up.
See, the thing is, whenever in between 2009 and 2014, the US markets were really weak, and I was a trader at that time. So whenever we used to go short the market, the Fed would come out with a large QE. So you could never make money, and everyone started calling it the Fed put. Then after 2016 onwards came Trump in the US markets, and whenever the US markets fell 10%, you would have Trump tweeting about it. Right now in the Indian market, the government is watching the market as much as we are, because every newspaper you read, it's all about one term, mandi, slowdown. It just starts and ends with that. When there is so much pressure on the government, we as stock market investors need to be relaxed a little, because now the ball is in the government's court. So the large price correction won't happen, because every Friday you'll have Nirmala Sitharaman coming in and bailing us out. Yeah. So that's what we believe in. So we're buying the dip, and we're still in the quality side of the basket. So we've stuck to quality financials, quality consumer. This is not the time you go out and buy junk and then expect to make a lot of money. You still have to be up on the quality curve, because the economic growth is yet to come back. So there's no growth in the economy. Like yesterday, I was with an NBFC owner, one of the top 10 NBFCs, and these guys are facing problems to raise 50-100 crores, and that's and these were the guys, and he told me, like 1 year back, exactly the same date, my book was exactly the same. When I used to call the banker and tell him that I want 100 crores, the same SBI or same banks would tell him, yaar 100 crore kyun le rahe ho, 500 crore lo. And today when they ask for 50-100 crores, it's a mess. So till the time the NBFC situation doesn't get read like proper, you will not have economic recovery coming in. So it's going to be a slow, steady recovery on the economy side. But then wherever market sees growth, you'll see prices getting bid up. You see how markets bid up life insurance companies. Today we were like, I met with all life insurance companies. Ambit is having a life insurance day. So there as well, like what HDFC did, they sold Sanchay Plus, HDFC Life. And that's a fixed guarantee scheme, and where as soon as markets saw growth, you saw stock prices going up 40-50%.
You're rewarding even the slightest of positive.
Absolutely, because money is chasing growth. There's too much money, too less stocks. So where do you go? And all other sectors, you see, where does money go? You have to be in growth. Like we've got aggressive on consumer technology. That's one space where we've started. There's a new IPO which came. It's a market monopoly, 30% free cash flow growth. See, there are going to be opportunities. It's not going to be like 2017. There are years like 2017 that come. It happened in 2014. It happened in 2010. It happened in 2007. It happened in 2003. It happened in 1999. So after every 4 years, you'll get that large small cap, mid cap rally. Probably if I go by that logic, we'll have a next small cap, mid cap rally in 2021. Somewhere around that. Probably that's the time we'll get a little more aggressive.
But do you think the government, with whatever it's been doing, of course, what we've been seeing recently is that whatever the government tried to do to lift market sentiment, Trump would suddenly tweet and dampen the sentiment. That's, I think, what we saw the last 2-3 times. I mean, even right now, we saw the crude price have a come by, Anyway, but that's aside. That's, of course, a global factor. But do you think what the government is doing right now, it is enabling a positive market sentiment, or do you think it's just
no, it's just too small? The time when they had to interfere in the market was when ILFS fell down, and that was a good time, because it started as a confidence crisis, then it became a liquidity crisis, and now we're dealing with a solvency crisis. So last week as well, we had Altea default. So it's a problem, Now you have, if you had to spend 100 rupees for a bailout, now you'll have to spend 1,000 rupees. But you have to bail this economy out, or else the economy is way too slow. No entrepreneur, like we meet so many managements, no management is saying that I want loans. And these guys are aggressive, greedy guys who, the typical entrepreneurs is pretty aggressive. And these guys are saying, you know what, I want to deleverage. So you go from Reliance to any other guy. No one wants to take new loans. They're like, no, we're done. The economy, I already have pending capacity. Why do I go out and have new capacity? So there's no one who wants to aggressively scale up. The large businesses, everywhere you see, the trend is similar, be it textile, be it power.
Nobody wants.
No
So I
one.
think that's the reason why, even if I look at some of your picks, right? I mean, Bajaj Finance, HDFC Bank, these are, your bluest of the blue chip names, because you think, I mean, in growth stocks, simply put, I mean, is that where really we should be parking our money then?
See, in a bull market,
Yeah.
we were chasing growth. So we were on the first decile of growth. Wherever we saw 30-40% growth, we were there. In a bear market, market chases quality. So market doesn't care about growth rate.
Yeah.
Market chases quality plus growth. So they will prefer, market will prefer a 20%. So basically in a bear market, you buy a Virat Kohli. In a bull market, you probably buy a Hardik Pandya. so that's how you play these cycles. But you have to get aggressive. In the next bull market, you will miss out big time if you be in these stocks only. You have to chase growth. And wherever there's growth, you will find us for sure.
Okay, all right. What about valuations? I mean, because some of the names that you've picked up, like for example, DMart, yeah, it's corrected a bit, but it's still quite demanding on the valuation front. Then HDFC Bank, of course, like we said, Bajaj Finance as well. And consumers, in fact. I think you mentioned consumer tech, but consumption. First, let's talk about that and then we can go to consumer tech. Why consumption right now?
See,
when
DMart is
when you are saying we're looking at a slowdown, right? I mean, nobody wants to buy cars and stuff.
DMart, see, look at last 10 years.
Yeah.
What stocks have created wealth? Wherever the customers love the product, be it Bajaj Finance or Jockey or, no person will say that 0% interest rate is too high for Bajaj Finance.
True.
They'll like, I want 4% or 5% interest rate. That's the same thing. Customers love DMart. If you see, this is a secular, see, a great business is where you get cash flows and you can consistently reinvest for a long time. DMart makes massive free cash flows because it's the lowest cost producer, so more people go there, and then he can consistently reinvest at 25-30% ROC for a long time. I'll just give you one statistics, Mobina. DMart has 170 stores. Tesco, which is like Tesco in the UK, which has just 6 crore population, has 3,200 stores. Yeah. So this supermarket have a very large runaway, and it's a game where the lowest cost guy always wins. I'll just give you one more statistic, sorry.
Sure.
But DMart operating cost as a percentage of sales is 8%. For Future Group, it's 24%. Yeah. For Reliance Retail, it's 27%. How do you beat DMart in this game? And this is a proven game. You look at Europe, you look at like Aldi, you look at how they have scale. Look at Costco. The guy who has the lowest cost always wins this game because then you can sell it cheaper and customers go there. It's a commodity. And this company will, according to me, should not come down below 80p for now.
Okay.
So that's what we believe in. So around 12,
very
1300.
demanding valuation. You have to live with it, I suppose, if you want to buy such a business.
These are high quality proven businesses. They're globally proven, Mobina. So when you have a globally proven business, good management, moat is cost. So till the time that moat remains, this thing will be there.
Okay.
So growth, quality, and you don't get that cheap in India.
Let me come back to that whole consumption discussion that we were having with Amit. And Amit, you talked about consumption. We spoke extensively about DMart. Consumer technology. Are you looking at basically all these new tech companies that have come that have a high, perhaps high exposure rather to digital shopping online, that kind of stuff? And also, where is the opportunity in the listed Indian equity space to get exposure to such new age businesses? Because I think most of it is eaten up by the startup side.
See, I'm telling you, trends are global. So this is one of our trend portfolio. Our portfolio is divided in two parts. One is our consistent compounders and 40% is our high growth trends that we play. Trends are global. If you see 1996 to 2000 was not an Indian IT trend. It was a global IT trend where Yahoo, Amazon and all those stocks and India, Infosys, Wipro went up. Similar was 2003 to 2007. The real estate trend was global. And that's how your subprime crisis happened and Indian real estate commodities went up. Then in 2009 to 15 was also a pharma trend, and even Dow Jones Pharma Index went up 5x. So it was not just your Indian Sun Pharma and Lupins that were doing well, even Dow Jones Pharma Index was doing well. Today the trend is in platforms, all your FANG stocks. Look at the amount, like Shopify, it's gone from 1 billion market cap to $40 billion market cap in the last 3 years. This .com name is where the trend is. This is what we believe. But it doesn't mean we cannot sell them out. These are places where it's a winners take all. A platform business, a winners game, all take all game. There's a new listing which has happened. That is something that we bought on IPO day. There's one job site which does investment.
Which one is that? Which is the new listing which you?
We bought India Mart. So okay. India Mart we got in. Naukri we have in our portfolio.
Info Edge.
Yeah, Info Edge we have in our portfolio. Those are stocks now. New competition also coming. But these are these are trends which I can see where you have consistent 20% growth in Naukri and which is invested by Sanjeev Bikhchandani, who looks like a smart guy. into Policy Bazaar, Zomato, and those kind of new startups. So that's where we believe there can be a large trend. We're doing okay on that side of the portfolio for now. We've got Reliance as well, but that has deleveraged problem. As soon as the deleverage of Reliance gets over, you will see Reliance with 80-90,000 crores of operating cash flows, with an execution of Mota Bhai. This guy becomes a legendary, and like it's a great combination. So.
But leaving aside Reliance retail, of course, but these other companies, would you be worried about the bottom line?
For
the Info Edges, the Matos, etc., because they're known essentially, for the loss figure on the bottom line on an annual basis.
See,
or you're not too.
If they can sell it, then it's not a problem.
Okay.
This startup game, see, these are modern monopolies.
Yeah.
And if you see in a platform business, your OPEX is your CAPEX. So it's like they are negative free cash flow right now. For a manufacturing company, for example, you'll have 2-3 years of negative cash flows because you're in the building of a plant stage. That's the similar stage at which these startups are there. These are the modern monopolies. These are unreplaceable. The customers love them. So I am very bullish on platform kind of businesses. Of course, we can keep changing our horses. These are these are not something where I can see for 10 years and hold. I review them quarter, 6 months, and then decide.
You ride the trend.
You ride the trend till the time. If FANG stock's correct, there the game's over here as well, and we may sell out. So you need look quarter to quarter and ride them. But that's where money will be made. Platforms, high growth. High ROCs, market leadership, free cash flows, those are things that work in markets typically.
And in our market right now, we need quality and growth.
Of course.
There is no way we are looking at junk.
Of course.
Right.
No junk at all.
Okay, all right. Amit, thank you so much. A pleasure having you with us on Markets at Lunch. Well, that's Amit Jeswani's advice. Ride the trend and, of course, stay away from junk in the Indian equity market. And, of course, he told you about the Nirmala put, a new terminology that we have heard where the government excessively gets involved in sort of boosting market sentiment.